Hi, I'm Corey. I'm a CPA and subject matter expert in managerial accounting. And in this video, we're going to discuss the concept of variance analysis for materials. We'll start off by going through what variance analysis is and discuss how this can be used to evaluate a company's ability to manage their materials expense. Next, we'll talk about how companies can use variance analysis as a tool to continuously improve operations by looking at a specific example. Understanding this concept can help companies manage their resources more effectively and make smarter long-term decisions. So let's get started. Manufacturing companies spend a significant amount of money each period on the raw materials that go into producing their products. A company's ability to manage and control these costs can be the difference between a profit and loss each period. In order to plan for future operations and control spending, most companies produce monthly direct materials budgets, which they can use as a tool to evaluate how effective they were at managing both the price and usage of their materials. At the end of each month, this allows them to compare their actual results to their budget and pinpoint the areas that didn't go as expected to plan. This is the materials variance analysis process in action, where companies identify specific differences or variances in the amount they spent on materials. This allows organizations to investigate areas of concern so that they can improve going forward. The starting point for a materials variance analysis will be to calculate the total materials variance. This is done by comparing the actual cost of the materials to the budgeted amount that the company was planning to spend. The actual cost is calculated by taking the actual price per unit of the materials, or AP, times the actual quantity of materials, denoted by AQ. The planned cost is calculated by taking the standard or budgeted price per unit of materials, or SP, times the budgeted quantity of materials the company was planning to use, or SQ, which stands for standard quantity. The difference between the actual cost and planned cost will be the total materials variance. Depending on the circumstance, the variance could either be favorable or unfavorable. Favorable variances occur when the result has a positive impact on the organization's profitability. This would occur when the company's direct materials cost is less than they were planning for the period. For example, let's say a company budgeted to spend $20,000 on direct materials. However, they actually only spent $16,000. This would leave them with a $4,000 variance between the actual and budgeted amounts. In this case, since the company spent $4,000 less than they planned, this would be considered to be a favorable variance. Unfavorable variances indicate an adverse situation when the actual cost is more than the budgeted cost. Let's go back to the previous example where the company budgeted to spend $20,000 on direct materials. If something didn't go to plan and they ended up spending $30,000 that month, they would end up with a $10,000 unfavorable variance since they spent $10,000 more than they planned. Anytime a variance exists, it's important that the company identify whether this is favorable or unfavorable so that they can make a decision on how to proceed. Determining these variances between the budgeted values and actual results is only the first step. The next step, which can be even more important, is to spend time investigating the variances by breaking them down into individual components to determine where the root cause of the issue originated. Department managers can also be interviewed for additional insight. In the example that we just discussed, where the company had a $10,000 unfavorable direct materials variance, they'll want to get an understanding of the root cause behind this. If they can determine why management spent more than planned, they can try to rectify the issue so that it doesn't continue going forward. Was it because the purchasing department bought the materials from the wrong supplier and paid a higher rate than planned? Or was it because the operations team used too much volume of material during the production process? These are the types of important questions that will need answering in order to improve things going forward. More on this to come shortly. Now that we understand a little bit more about the variance analysis for materials, let's talk about a common misconception. Just because a materials variance is unfavorable doesn't automatically mean that the company managed their costs or processes poorly. It's possible that there were elements outside of the company's control that led to the result. For example, there could have been economic factors that impacted the supply of raw materials, or unexpectedly high levels of inflation in the markets. This would likely result in the company having to spend more money on their direct materials than they would have originally budgeted for, creating unfavorable variances. So while variance analysis is an important tool, it's important to remember that there are some limitations here. Let's go back to the materials variance analysis from earlier, where the company had a $10,000 unfavorable total materials variance. Like we discussed, this means that they spent $10,000 more on their materials than they had originally planned. While this gives management some information, it doesn't tell the whole story. Now, in order for the company to understand what went wrong here, it's important for them to break this variance down further to determine whether it was the responsibility of the production department or the purchasing department. To do this, we would break down the $10,000 variance further into both price and usage variances. To drill into these variances, we need some additional details about price and quantity. Here we can see the actual price was $14.50 per pound of material. The actual quantity was 2,069 pounds of material used. If we look at the budgeted information, the standard price was $10 per pound, and the standard quantity was 2,000 pounds. Let's calculate the price variance first. Price variance is the difference between the actual and standard unit price of material multiplied by the actual total quantity of material used. In this case, that would be the $14.50 actual price minus the $10 standard price times the actual number of pounds, which was 2,069 pounds. This results in a $9,310 unfavorable variance. Usage variance tells us about how efficient the company was with their materials by taking the difference between the actual and standard quantity of materials and multiplying it by the standard price. In this case, that would be the 2,069 actual pounds minus the 2,000 budgeted pounds times the budgeted price of $10 per pound, resulting in a $690 unfavorable variance. As we can see here, the total $10,000 unfavorable materials variance has been broken down across price and usage variances, with over 90% of the variance originating from the price. Calculating these variances would help the company determine where the issue originated. Now, it's possible that the variance resulted from inflation or economic factors that impacted the cost of the materials. It could have been from the purchasing team spending more than expected on the price of the materials due to inefficient procurement, or the production department may have ended up using more volume of materials than anticipated. It's also possible that the company didn't accurately budget in the first place. However, in this particular case, it looks like there are some possible issues in both these areas, but the company would likely want to spend the majority of their time investigating the price issue with the purchasing team, since this is where the largest variance is originating. And that brings us to the end of this video. Variance analysis for materials is an extremely important tool that companies can use to manage and improve their profitability. It allows organizations to both pinpoint areas that are going well in the company while also narrowing in on areas where improvement might be necessary going forward. If you're interested in learning more about this topic or others, please feel free to check out our additional videos on many more related topics.